You are listening to The Vocal Technologist. Spoken Tech for your ears.
I don't know about you, but lately, trying to keep up with fintech feels like trying to read stock ticker tape at the speed of light.
Oh, absolutely. It's moving so fast.
We are so far past the theoretical idea phase.
Yeah.
Everything from how global banks manage risk to how you pay for coffee it's being deployed and rebuilt in real time.
Okay, let's unpack this.
Let's do it.
Today we're looking at two massive sort of parallel revolutions happening at the same time. First, you have this incredible integration story, how legacy institutions are finally giving digital assets the keys to the vault.
Right.
And second, and this is maybe more radical, is how AI is fundamentally changing who or what executes a transaction. We're heading into this age of autonomous commerce.
Precisely. We're connecting the dots on how regulation and technology are forcing these huge institutions to integrate or, risk becoming completely obsolete.
And on regulation, we have to talk about the catalyst for all this.
We do. You hear a lot of chatter about the improved U.S. regulatory environment, and a lot of that points back to the Genius Act.
Right. And for you, the listener, what's important about the Genius Act is that it basically clarified the roles of the SEC and the CFTC. And that clarification, that stability was exactly what Wall Street was waiting for.
That green light.
That was the green light. It let the big players finally treat certain digital assets seriously. The whole conversation just shifted from if to when.
And that clarity is now translating directly into massive institutional commitment. Let's start with probably the clearest signal that digital assets are mainstream. JP Morgan Chase. JPMC is moving so far beyond just accepting a few crypto-linked ETFs. By the end of this year, they're actually stepping up to accept Bitcoin and Ether. Directly as collateral for institutional loans. That's not a test run. That's putting digital assets right into the heart of Wall Street's lending machine.
And it's fascinating how quickly everyone is moving now that regulatory risk is, mitigated. You look at JPMC and might think it's a one-off, but this pattern is just repeating everywhere.
Everywhere.
Look at Citi. They're actively partnering with Coinbase to build out these huge digital payment solutions for their institutional clients.
So what does that actually look like?
It's a two-way street. They're covering everything from standard fiat deposits and withdrawals to exploring actual stablecoin conversions. They're building the superhighway between old finance and new crypto.
But is it a genuine embrace, or are they just trying to manage risk until they can build their own walled gardens? Because it's not just investment banks.
No, it's not.
We're seeing major payment giants jump in, Zelle's parent company, Early Warning Services.
Right, the banks that own Zelle.
Exactly. They're planning to use stablecoins for faster, cheaper international payments. And they explicitly said it's because of that regulatory clarity.
And even Western Union.
The old guard is developing its own stablecoin, USDPT, for cross-border payments. They're adapting the tech, not trying to kill it.
And we have the data to prove this is driving real-world use, not just speculation. We've seen stablecoin use for actual purchases and transfers surge. What was it, 70% since July?
A 70% jump. It's huge.
Total transaction movement hit a staggering $10 billion in August. That's up from just $6 billion earlier this year.
And the critical piece here is who is driving that.
Yes. This isn't just crypto enthusiasts. Business payments are dominating this surge. We're talking $6.4 billion a month.
Wow.
Companies are just using this stuff to bypass the slow, expensive, frankly outdated international banking system. It's a pure play for speed and efficiency.
Okay, so this shift to faster digital rails is incredible, but it still needs a person, right? Someone still has to click send.
For now.
Here's where it gets really interesting. The next revolution isn't just the rails, it's the driver. It's autonomous AI. We are walking right into the agentic economy, where machines don't just report on money, they move it.
And what's fascinating is the sheer scale of this idea. The whole concept of agentic payments suggests that pretty soon, software agents will be moving more transaction volume than humans.
More than people.
More than people. Think of an AI negotiating a supply chain contract, arranging its own insurance, and then instantly paying all the vendors with zero human intervention.
That just requires a completely different kind of payment system.
Entirely new rails, optimized for real-time machine-to-machine transfers.
And the biggest players are already laying the tracks. PayPal just signed a massive deal with OpenAI. They're going to be the first full payments wallet embedded directly inside ChatGPT. So you could just prompt the AI confirms a purchase, and the money moves, all inside the chat.
And at the same time, you've got payment processors like WorldPay backing this new agentic commerce protocol, the ACP.
Okay, so what does the ACP actually standardize? Is it just machine-to-machine payments, or is it something bigger? I mean, this is the kind of insight we love chasing here on Vocal Technologist.
Well, the ACP is trying to create the standards for these autonomous transactions. It's about ensuring secure, real-time settlement and data exchange, specifically for AI agents talking to marketplaces. It's the foundational plumbing.
And when you start laying that plumbing,
It immediately raises a big question. What happens to the human financial worker?
right,
And the disruption is starting right at the top. Sequoia Capital is pouring money into a startup called Rogo Technologies.
I saw that. Valued at $750 million now.
Exactly. And Rogo automates financial modeling, IPO docs, slide decks. It's basically software acting as an AI analyst. It's replacing those expensive junior banking jobs, the entry-level roles to get into elite finance.
And it's not just startups. The big tooling companies are at war. Anthropic just rolled out a version of Claude AI specifically for finance.
Right, it plugs right into Excel.
It integrates directly into Microsoft Excel. So analysts can now analyze, build, and audit models without ever leaving their spreadsheet. That's a direct shot at Microsoft's own Copilot.
It's all about replacing the analytical grunt work. And for the big banks, this is a huge threat. McKinsey just put out a warning.
Yeah.
They said as consumers start using these AI agents to autonomously optimize their finances, automatically switching savings accounts for a better interest rate, it could just decimate bank margin.
How much are we talking?
A potential $170 billion profit hit globally.
$170 billion. That number is staggering.
Yeah.
It completely changes the bank's relationship with you, the customer.
It does. AI turns what was a stable, profitable relationship into a commoditized utility pipe, driven purely by rates and efficiency.
And that margin erosion happens because the AI agents can just seamlessly switch accounts and move money based on pure data.
But to do that, they need access. Reliable, frictionless access to consumer data, which brings us right to the huge debate over open banking.
So the fight moves from the back office analysts right to the consumer interface. And the potential for services like Pay by Bank, I mean, it's massive.
Huge potential.
Adoption in the U.S. is still pretty low, around 6.4%? But our understanding is the main problem isn't distrust, it's just awareness.
Just awareness, the infrastructure, the faster rails, it's all ready for growth. And we're seeing some big banks trying to push that awareness.
Like who?
Lloyd's, for example, partnered with a tech firm called Lolly to introduce Pay by Bank self-service kiosks.
In restaurants and things?
Exactly. You scan a QR code and pay instantly from your banking app. It promises lower merchant fees, immediate settlement. It's a direct attack on the credit card networks.
But underneath all this cool innovation, there's a massive regulatory fight brewing over who gets to control that data.
Precisely. The American FinTech Council is pushing the CFPB hard right now to prohibit data access fees.
Because the banks want to charge for it.
They warn that if big banks are allowed to charge fintechs for accessing customer data under this open banking framework, it would stifle innovation. You would cut off millions of people who rely on those third-party tools.
So while the industry fights over old data, a totally new class of assets is suddenly gaining legitimacy.
Yeah, talk about a surprising shift.
We have to talk about prediction markets.
The NHL?
In a huge move, the NHL signed multi-year deals with Kalshi and Polymarket. This is the first deal like this with a major U.S. sports league. They get to use official data, official logos.
It's a huge signal. It brings these, niche digital assets much closer to the mainstream of regulated finance.
Even though you have groups like the American Gaming Association immediately calling them backdoor gambling schemes.
The market is just moving faster than the definitions.
And as this whole system speeds up, integrating new assets, autonomous agents, the need for security just has to be skyrocketing.
It has to. The money needs to move fast, but it has to be clean. Global spending on anti-money laundering, on AML systems, is projected to more than double in the next 5 years.
Double from what?
We're looking at a jump from about $34 billion in 2025 to over $75 billion by 2030. And that spending is all driven by banks scrambling to close compliance gaps in a world where money moves instantly across stablecoins, prediction markets, and AI protocols.
So what does this all mean?
Where do we land?
We've seen two massive forces colliding today. You have the top-down institutional integration of digital assets, making crypto collateral and stablecoins just part of the fabric now.
Mm-hmm.
And then you have the bottom-up AI-driven shift toward autonomous agentic transactions, and the common threads driving all the growth are precision, data access, and autonomy.
And we've seen that the established players are taking huge technological steps, but the real challenge is, can these legacy institutions evolve their operational rigor, their entire way of thinking about risk fast enough to keep up with the exponential growth of these AI agents?
That's the billion or $100 billion question.
It is. The next few years will really test whether banks can embed that kind of precision into every single decision before the AI agents just eat their core profit margins.
That leaves us with a final provocative thought for you to mull over. If AI agents are proactively optimizing your personal finances, actively monitoring rates, switching your accounts, and moving money for you, who exactly is your primary banking relationship with? Is it the bank or is it the agent? We'll see you next time.
Spoken Tech, for your ears.